G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out my links below, including exchanges I use and social media content that I post. All right, let's go. So the topic for this video, we're going over the United States Federal Reserve interest rate decision and what occurred this morning, 4 a.m. AEST time, Australian time, or late last trading session for the US, and see what happens in this meeting and what the rate cut turned out to be. So I did project the rate cut was going to be 25 basis points because we did get a lot of mixed bag of different projections, and Ray Dalio 25 basis point cut would be the right thing to do, he said. And then you had JP Morgan's Jamie Dimon very, very adamant of a 50 basis point cut and not looking forward to the economy ahead. He's saying it's going to be interesting times ahead with potentially stagflation, and I do think he sees a recession coming. So there's him, and then there's other banks too, 25, and then 50s all over the shot. So it was a very mixed and predicted market, but we did have the CME Watch tool shift from the rate cuts going from 75-25 to 75 in favour of 25 basis point cut and 25% chance of a 50 basis point cut well before this meetings weeks ago. And then now they've just sort of shifted this last week. Basically, the odds have gone from that to 60-40 to 40-60 to, and then nearly 70-30 in favour of a 50 basis point cut. So the odds were really creeping up right at the last minute, and it did turn out to be a 50 basis point cut in the end. So you have it here, so you can see the forecast was 25 basis point. Okay, you can see it's 25 basis point from 5.5 to 5.25 or thereabouts. It's in a target range. So 5.25 to 5.5 is where it was, and they cut by 50 basis points. We're at 5. So it's 4.75 to 5 is where it's at the moment. So there is a target range, which is a little bit confusing, but from that target range to 4.75 to 5 is a 50 basis point cut. So they cut more aggressively than expected. This is the first cut since 2020, I believe. So that's since the pandemic. Okay, so if you go back 10 years ago, I should go, and then you can see the last cut ended up being here in March, where the pandemic was. Okay, so that was a big ginormous cut. So you went from 1.75, this flat period, all the way down to 0.25. So it was 1.5% drop in rates at the Federal Reserve level, and they stayed pretty much flat from 0 to 0.25, and then they started hiking in February, or March, I should say. March, they started hiking, and then they stopped in July, and then finally, after a year, they've cut. After raising rates, they've cut, and the first time since the pandemic. And this is a big one, big 50 basis point cut, which is very unexpected. Up until last minute, really, and the projections and the CME Watch tool did change. Okay, so that was that one. I'll show you what's looking forward for the next meetings, which is in November and December. So we'll have a look at the CVF Watch tool. So for the coming up meetings on the 7th of November and the 18th of December, so the two last meetings of the year that have one in October. So they've skipped October and they go to November and December. And as we can see, the probabilities of a 25 basis point cut, so going from 4.75 to 5 is where it's at the moment. Okay, it's in that target range. So if they're going to go to 4.5 to 4.75, that's a 25 basis point cut. Okay, and the probability is 65% of a 25 basis point cut and 35% chance of another big 50 basis point cut. So the odds are favouring 25 basis points again, like they did for this meeting. But up until the week of, they could always flip. Okay, so just be wary of that. These probabilities change so frequently, depending on the incoming economic data. And then December, we have essentially another 25 basis point is So it says here from the 50% chance versus 32.5 for a 50 basis point cut. Again, okay, so going from the 4.75 to 5 is where it's at the moment, okay. And that goes down to here for December. That would be I believe it's 50 basis point cut. There's 50% chance of that happening, okay. And then going from 25 basis points is a 32.5% chance. Yes, that's correct. So, yeah, so hard to read these tables, but that is what's going on. And, yeah, so 2 more cuts are priced in for the end of the year. Now we got some tweets. This is a bit of a funny one. Before Power gets on stage and starts talking. We'll play this one for you right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices.
So, yeah, when Power gets up on the stage and starts talking, the volatility kicks in and bam, price moves up and down or zigzags, whipsaws, and if you're trading these markets, you're absolutely going to get wrecked. And that's just funny video. Just hear this guy zooming in on his phone, seeing the prices drops like a rock. That stuff happens. It's very volatile. These speeches, his Federal Reserve, especially Jerome Powell, because he's the head of the Federal Reserve. And yeah, don't trade even the whole day. Don't touch it. Even when there's economic reports, like non-farm payrolls come out, or CPI numbers, they're the most volatile days in the Forex market, and any market you trade, and boom, that stuff is very, very likely to happen, and you can get wiped out in seconds. So yeah, don't do it. All right, next tweet by Brett_ETH. January 3rd, 2001 was a 50 basis point cut. September 18th, which is what we just had, but going back to 2007, was a 50 basis point cut. March 3rd, 2020, 50 basis point cut. September 18th, 2024. Yes, today was a 50 basis point cut. And guess what? These are the last 3 times the Fed has initiated its cutting cycle with a 50 basis point cut. And this chart represents it. Okay, so after the cut happened, what happened? The NASDAQ fell 56% in 2001. 2007, the GFC. The markets did rally a little bit higher after the cut happened, and then boom, they fell 53%. In 2020, in March, when they started 50 basis point cuts, what happened? The market fell a further, so it was a little bit higher than that, but from this cut, it fell 23%. All right, so that's the 3-day time frame. And yeah, so the previous 3, when they started cutting by 50, especially the GFC and the dot-com bubble, these 2 was the beginning of rate cutting cycle started at 50 basis points. Whereas these cuts in 2020 actually started in 2019. In July, they started cutting by 25 basis points at a time. And then the 50 basis point cut came in March 2020. And obviously the markets didn't like that. So yeah, you'd be very, very cautious going ahead, because I showed you .com, it just dropped, right? And probably did rally a little bit after that cut, and then bam, dropped. This one rallied a little bit higher and then dropped. This one just fell off a rock. So it just went straight down. Okay, just a big fast moving train that cannot be stopped. So it just fell off a rock. Okay, so that's what happens. These markets are very unpredictable, but eventually they resolve to the downside because the cuts aren't occurring, especially this magnitude. A 50 basis point cut don't occur for good reasons. It's for seeing weakness in the labour market, and that's why they cut aggressively. All right, and these were the cuts related to that problem. We had the labour market. Okay, the 2021 was more of a black swan event. That was the pandemic, of course. So just before it happened, and they had a bit of a repo banking crisis in 2019. So they had to cut in 2019 just to stimulate that market. And then after that, it was the fears of a incoming black swan. So besides that, you had these 50 basis point cuts, and they were bad for the stock market. So it's letting you know, just be cautious of any further rallies, and they won't really be sustainable, as history shows us. And if you go back in further, I'll go in the charts and show you further back when the 50 basis point cuts come in and see what the markets did when they responded to it. And that is the tweets. So we're going to the charts. For overlay recessions, you can see that obviously you had these cuts. So that up here, was if I get the mouse straight, it was 2.5, went down to 2.25, so 25 basis point, 25 basis point again, 25 basis point, a flat, and then as soon as they cut by 50, recession kicked in, and boom, and it wasn't good. Okay, so it was 2020 I was just referring to in that tweet. Okay, and if I go back to this one, which was a GFC, of course, they cut by 50. The markets did rally a bit more, and then they cut from 4.75 to 4.5, 25 basis point. Then another 25 basis point cut, and then a fifth, and then from 4.25 to 3.5. So it was a 75 basis point cut, an even bigger cut. See that one compared to these ones, 50 basis point, and they're 25s. And the recession started pretty much straight after that. Boom. All right, so the recession happened when the big cuts came, and this one straight away happened. So from 6.5 down to 6, boom, recession straight away. .com bubble. And then we have these periods here. We went from 6 to 5.75, so 25 basis point, a 25 basis point again, and again 25 basis point. And then it went from 5.25, okay, to 5.5, so 25 basis point increase. And these were 25 basis point step downs. And these are 25 basis point steps up. So they're very, very gradual. This from 6 to 6.5 was a big 50 basis point rise. And then eventually, the cuts were aggressively bad. So they didn't have any 50 basis point cuts here. They occurred here, okay? So from 6.5 down to 6 right here. All right, so you can see, and that was the recession. So that was not a recession because it didn't have these big cuts, but the labour market was a bit more stable then. It was not so back in 2000 to 2001. And this 1990 period went from 9.75 to 9.6, so 15 basis point cut. And then it was a 35 basis point, so almost 50, and then 9, and then went from 9 to 8.5, so that was a 50 basis point cut. And then from this period of October 1989 to July 1990, so not long after, it was it was about 9 months or so later, it was a recession. So it did take a bit longer to kick in this 1990 recession, right? Then we had these periods with rates just declined rapidly, okay? But unemployment was going down, so that was a good sign. So we had, 11.75 down to 10, so that was a huge cut. And that was no recession there, okay? But you did have recessions here. This had a very, very bad inflation issue back in the early 80s, okay? 1980 and 1981. And we had big increases and decreases, so whipsaws. So going from 20%, imagine paying 20% on your mortgage per annum, to 15.5%, so 4.5% drop in rates is huge. It was aggressive. Then we had recession when they went from 15.5 to 14, so 1.5% drop in rates and recession. Okay, so I'm just showing you now that the big cuts that come, these big aggressive rises, and they used to come down pretty aggressively. And that was the 1974 period. Okay, and so 25s don't do a lot to scare the markets, but 50 basis point and beyond is not good. All right, so there's that one. I have an interesting chart here. So recessions again, highlighted in red. This is US interest rates minus the US Treasury 2-year yield. Okay, so take the 2-year yield. So I showed you in the previous video how correlated they are, and you take that off the interest rates, and it gives you this really interesting chart. Okay, so obviously recessionary period, we go to 1990, and it didn't occur a bit later, but we had these big spikes up, big drops down. Okay, so it's very interesting. It's a bit like an oscillator. So you have your top range, if you measure it out, okay, from these wicks about there, and then the bottom is roughly around here-ish, okay? Give or take, some wicks and deviations, okay? But it's the tops that really matter, okay? Because right before the recession occurred. So right before the recession occurred in 1990, we had a big spike up to the 1.6 level, and we declined. Back up, recession, bam. So this was the first one on this chart I can show you. And it went down to this lower band. Okay, obviously recession was well and truly over by then, but yeah, it went to this lower band there. Let's look at the up bands. It's probably more important. I'll get rid of these bottom ones, don't really matter, but it's more the upper bands, right before it occurred. So we came close to this line and didn't hit it. But 2001, .com level, and it just shoom, straight down. Okay, boom. You got close to these levels, very, very close, and dropped off. And 2008, we came up to it, and we wicked, and then right before the recession, then bam, sold off. So there you go, recession there, line up with this level, and you go to the 2021, and it didn't. Okay, so it's not perfect, and now we're smashing right through it. Okay, in 2024, we are smashing straight through, and higher than we've ever been, according to this chart. So yeah, I don't know how bad this result recession-wise, but I don't think it's going to be too bad, because this recession here in 1990, I went pretty high up. It wasn't very bad a recession. It was pretty mild. This went a little bit less than this one, and we shot right down. And that was obviously the .com level, which is pretty horrifically bad. And the GFC was even worse. It went slightly higher, but nevertheless pretty well the same as this one. So yeah, the outcomes aren't going to be the same. They're all going to be different. And this one was a phase of sickness. And it went the lowest at all of them, okay? And this actually fell more than the 99 recession. So yeah, this is more volatile, this move, but as you can see, it dropped pretty aggressively here. But yeah, nevertheless, that is just an interesting chart to look at. So you see that we are at these peaks again, roughly, within them, in distance, okay? And we should see a big decline after. Eventually they do drop and recession kicks in. So that's the main point, is you get these periods where it declines rapidly, okay? Not a good drawing, but you get it. It's these big sharp sell-offs, okay? And that's the recessionary environment. These big drop-offs, not these little shallow ones, but these big aggressive ones, okay? And yeah, recessions occur. So that is that. And we have TLT, which is a 20-year Treasury bond ETF, and it sold off on the day, which is very surprising. It should go up, but the bonds didn't shoot up. It went down, and the yields went up. So yields are inversely correlated to the bonds, of course, and went above this resistance level, and it's coming back down. And I do see it coming back pretty close to this trend line. Hopefully it does. And I am potentially looking at a position in TLT. I'll have to wait and see. The levels get hit. Well, I'll have to do some more TAO on this one, but, around the 95 level looks interesting to me. So this wick here to this wick, somewhere around here. And you can see this level here too, and here. So we had some levels line up. As you can see, this here, deviation, but got close, wicked above it, here, and then potentially here. So if you do come down and then shoot up again, that'd be fantastic. It's only hindsight, but yeah, I'll be potentially looking at a position somewhere around in this vicinity for TLT and ride it up as high as I can. And yeah, just as the market goes down, and this thing should go up in inverse correlated fashion. And also, if you do want to bet against the stock market eventually, when it starts to drop off, you can buy like a ProShares ETF, which is a ProShares short S&P fund or NASDAQ fund, which basically is the inverse of the S&P and NASDAQ, and they go the opposite way, exactly the opposite, inversely correlated. So if the S&P goes up, it goes down. And if the S&P goes down, you make money if you get on the upside, just buying the ETF. So that's another way you can play this downfall. If you didn't want to use any leverage, it's a smart way to do it, just by buying straight into these ETFs. And yes, TLT is one of them, just a bond. It's more safe. Then you got the ProShares short for the S&P and the NASDAQ. So we have S&P on the day, and we did wick up and came back down again. So it was a big whipsaw up and down. That's why you don't trade these days. Up, it shoots up and it tricks people. It goes above this high, right? And this high, of course, and then it drops. So big fake out, which is not good, but just don't trade it because you didn't see that it can go back up again. So very unpredictable and very volatile times because the uncertainty and the emotions of the market, what the 50 basis point cut triggered, okay? And the NASDAQ did go down a slightly more, 4.45%, and went up and then down again. So whipsawed, and we're at this trend line as resistance, as you can see. Formed it back in 2023, came back to it here in May this year, came back to it in July. We came off a cliff and then back up again, and now we're finding resistance here at this level that I've drawn out previously, and we're struggling to get above it. Okay, and that was a seller point in this level here. And will we break up? And what I'm waiting for is this to get filled. Okay, this gap. Can't even draw today. This gap. This needs to be filled. So this open space. We expect this to go up and at least, fake the highs. Who really cares? But as long as we fill the gap, and then see you later. See you later, alligator, on the NASDAQ. So yeah, I just want this gap to get filled, and then I'll be confident that TLT, the markets go up, TLT should come down, and then get me in, and then boom. Okay, so that is what I'm seeing. And the futures, you can see the futures are actually up, which is positive. So we have the S&P ES1s is look at that. So you had to whipsaw down the fake out, and now we're like slightly above it in the futures market. So that just basically it shot up, and now the losses have been absolutely made up, and the gains are straight above it again. So that was just a big whipsaw fake out, and then boom, the real move is the pre-market, which is quite strong now, 1.34%, and new all-time highs have been hit. And NASDAQ is slightly higher, of course, 1.8, and we're above this fake out day, and we're heading up to this gap. Okay, so it's 19,933. Okay, and which is roughly around here. Okay, so roughly at this high level, right? So then you go a little bit higher, and then the gap is being filled. So that is the S&P and NASDAQ. The NASDAQ is what I'm waiting for to get filled, and the S&P has no gaps. Okay, so it has been filled already, and the futures market is looking quite nice, looking very bullish. Look at that candle. This is nice and fat and solid. So this session should be an interesting one, and we should see some gains. So that is those markets. And then to finish up, we'll talk about Bitcoin and daily and what occurred. And we actually had a bullish day, and after the FOMC, so down, we struggled to get above, and then boom, broke this resistance level at 61k, and we are actually getting slightly above it, but we are sort of stuck a little bit. We sort of shot up to 62.5. Now we're at 61,950, so 62k. And will we continue to the upside and come up to this high around 65k, right? And then head to the top of this parallel channel before going higher. Who knows? It's the mania phase. And then, boom, 100k Bitcoin. eventually into 2025. Okay, so that could potentially play out, but very low chance, I think, because the Fed's cutting this aggressively straight away, like 50 basis point. That is, to me, not a good sign, and I do think that they're undershooting their sort of hopes for the economy and the labour market in particular. The inflation numbers are coming down, so that's good, but the labour market is sticky. And, unemployment, 4.2%. It did tick down from previous 4.3. Okay, so it did have a August drop, but July's numbers were from 4.1 to 4.3, so that was quite a big jump, and then 4.2. There's a little tick down, and we see another big rise up, and then we can start seeing these basing periods where it just goes parabolic. Okay, it just takes off and just accelerates, and this is a surveyor sickness that just straight line up, so that was a bit of an outlier. But see, these bases get formed, and then boom, they shoot up. Bases get formed, and then they take off. So it just gets more aggressive the higher it goes, and you can see basing period, and then it just shoots up. Basing period, shoots up. Basing period, shoots up. Basing period, shoots up. I'll do it again. It shoots up. See, there's these basing periods, and then this one here. And one more. Okay, I've drawn that many of them. And what happens when these occur? Every single time I've drawn these yellow. So I'll get rid of this one. It's not this indicator. It's a different indicator. It is the recession indicator. What do we get? And it doesn't go back that far, unfortunately. But the other indicator did. So every time we get these yellow, so it shoots up. Boom, recession, 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 recession. And we haven't got one yet, but we're about to get a recession once this starts to take off to the upside, okay? And there were recessions here. In 1960, there was a recession. In the late 50s, there was a recession. Early 50s, there was a recession. And the late 40s, there was a recession. But this indicator doesn't go back that far. So the other recession indicator I had did go back this far, but for some reason it's not working. It's a developer bug issue. So hopefully they resolve that issue. And every time it happens, it's not a good sign. So that is the main trigger for the Fed. I think the Fed's looking at this going, we're about to take off like every other time in history. This time is not different. So, potential weakness ahead, labour market, but we have to watch for the numbers going ahead to see what that happens. All right. So that is the unemployment rate. And that is the video. So I hope you enjoyed this one. Just going over the FOMC rate cut decision and seeing that the rate cut came in at 50 basis points, which is huge. And I predicted 25 basis points, so I was wrong. Okay, I admit that I was wrong, but I think half the people were pretty much wrong and half were right. So it was a mixed bag, and it was a very uncertain rate cut decision, as I showed you in the last video about the probabilities and the uncertainty has never been this high in like 15 years or something like that. It's like 2009 has never been this uncertain about rate cuts. So you expect that. And it was interesting how the CVF Watch tool, the probabilities tool, predicted that, weeks ago it was 75 to 25 in favor of a 25 basis point cut. And then slowly, and this week especially, the probabilities just absolutely accelerated to the 50 basis point cut favorability. And by the end, it was like 66 to 33, something like that, pretty much. And it came out very late, the probabilities, and the probabilities end up being correct. The forecasters were wrong, and 50 basis point occurred. And I showed you some tweets. So every time it happened, okay, by Brett, I think his name was. And the 50 basis point cut, as soon as they start cutting with 50 basis points, the markets freak out and they drop. Okay, so pretty aggressively. So it's not a good sign. We can get a rally after it though, like I did in 2007. and the dot-com bubble did rally slightly and then just sold off pretty aggressively. So it can occur as well. So don't get sucked in. See this which is bullish, and you see the sentiment out there that people think, oh yeah, they're cutting aggressively. This is great. The economy is going to get so strong after this, and this is bullish for stocks. It is after a certain amount of time, because rates don't kick in until months later, because mortgages and that lag, and loans and for cars and credit cards and the rest of it, they do take a while to kick in. So these aren't going to be immediate effect. And late stage of the business cycle, this is what they do, is they cut into the end of the business cycle, which is bearish, not bullish. Okay, it's bullish after a recession occurs. And when the recession's over, then we can go and put our money to work and risky assets compared to traditional bonds and money market, fixed income, and safe investments. But you go to the more risky stuff when the recession's underway and out, essentially. So there's that one. And then, we went over the rate cut probabilities for the coming months, November and December, and seeing that next meeting is favourable 25 basis point, and then the one after that in December is 50 basis point cut is more certain to happen. And we just went over the charts as well. And I watched a funny video going over what happens at the volatile days. Don't trade during FOMC days and CPI and unemployment days and all that. So don't touch the markets then. It's just not fun to lose because it's very volatile and whipsawy. Like I showed you on the charts on the S&P, it went up and then just shot down. And now you can see pre-market, the S&P and the NASDAQ are going pretty aggressively higher. So you can get trapped pretty easily. All right. And looked at Bitcoin, seeing that we broke resistance at 61K. We're at 62K. And we'll see how high that goes. But it's only following the stock market at this stage. It's high on the risk curve. So I just see it's following the stock market to see what that does. It tracks it pretty closely. So there's nothing to really say there. It's just a proxy for its higher risk, like a tech stock. And looked at the TLT, looking to see if levels on that, and it did drop a fair bit, the 20-year Treasury bond. I do look at making a position in that one, a small position, and then build it up and make a good little profit. Nothing major, but it's something I'm looking forward to. Right around the market, it reaches its max peak and then starts to sell off. And the TLT pulls back and then gives me a good entry, and then I get in and ladder into the position and ride it up. Hopefully it happens. And as yields fall and bonds rise and stocks fall. Okay, so joining Warren Buffett eventually, as he knows this guy's smarter than anyone out there when it comes to stocks and businesses, and he's buying bonds like there's no tomorrow. So I don't doubt that guy. So I'm going to join in with him and many other smart investors. And there are inverse stock market. So S&P, NASDAQ, like ProShares short ETFs. So you can go against the market just by buying a ETF that is short. So it's inversely correlated to those indices, and you can just buy them. And then when the markets fall, you make money. It goes up. There's no leverage involved. It's just a straight inversely correlated ETF, okay? There are leveraged versions of it, but I wouldn't go near them. I'll just stick to a standard one. And, so that's that. And then potentially I've probably picked the S&P one. It's just less volatile and less prone to downside risk, okay? And then I'll look at the TLT. There's position in both of them. And, ride it up. These short ETF and the TLT to make profit on the way down, and then when the time's right, get out of that, and then get into the crypto market and play some high risk altcoins after the Fed has done with QT and starts QE. So when they start buying assets again, the balance sheet starts ticking up. That's when you get into the crypto market. All right, that's when the risk starts to shift, and the recession is well underway. As Powell did say that he was not ready at this stage to increase the balance sheet. He's happy to keep rolling it off as rate cuts come. So potentially see into 2025 that he hasn't started the QE process yet. So that's another thing to look out for. Very, very crucial for my strategy. And yeah, and we looked at the unemployment rate as well. Every time it shoots up, it's not good. It's recession every single time. So is this time different? You tell me. I don't think so. So yeah, it's 50 basis point cut for the first cut of this rate cutting cycle is not a pretty good sign. It's a pretty, I would say it's very, very bad. We'll have to wait and see. But yeah, Powell is dovish, as he always has been in the meeting. You couldn't even tell that he was concerned or basically, frightened of any data that has came for the labour market. He did answer questions very swiftly and repeated himself over and over and over, so you can get a clear answer out of him. And yeah, he is. I believe he's absolutely essing himself. So anyway, that is that. All right, so if you enjoyed this video, please smash the like, comment your thoughts below, subscribe to stay updated. Please be sure to check out the links below, and I'll catch you in the next one. Cheers.